Hello again, this is Alex with MasterChartsTrading.com and this is market recap for Friday, February 5th, 2016. I'm recording this video a little late because I'm traveling, so sorry for the delay. This week the stocks ended the week with a possible bear wedge break. If that's true, then we'll probably see a challenge to the recently set lows. Also, a correction of around 10% from today's prices seems very plausible. QQQ is showing signs of relative weakness. We'll look at that. TLT hit 52-week low, and more upside is certainly possible. So this is all showing risk aversion. Together with TLT, the utilities breaking out, but be careful with utilities as they're still stocks. Dollar index sold off against other currencies. Also, we'll look at some of the in-depth picture for gold and gold miners, as they were clearly the week's strongest gainers. Oil moved sideways, and there's a slight bullish divergence on the chart of natural gas. We'll look at that. Okay, so this is chart of S&P 500 ETF SPY. So I think this is a bearish chart. Long term, and within this bearish long-term chart, I was looking for bearish setups. Good bearish setup was here in December. The subscribers actually took this opportunity, and we're now sitting very nice gains. Now, recently we've been seeing this rebound with the spike low from 2000 from the 20th of January, and I drew in this rising wedge here. Now, rising wedge, this particular one was kind of difficult to draw because of the spike lows. I didn't know really where to draw it from, so I decided to draw it on the tops here, and then I just copied the line down. If this is the way to draw the wedge, then this right here on Friday is a wedge break with a close below the lower trend line of the wedge. Now, all of these are, kind of difficult to draw, so maybe this is not the wedge. So maybe the wedge should be drawn this way from the bottoms. So if that's the fact, then we haven't yet broken this wedge down. But in any case, clearly the Friday's action was dominated by the bears, and the price ended near the lows of the day. So that's not a good sign for the bulls, for the stock bulls. Further below, we see a brass momentum oscillator still in the bearish territory. Ideally, I would like to see a push into the positive territory for the bearish security, and then a rollover and into the continuation of the bear market. We did hit we did hit new lows for the advanced decline lines here in January as well. So all of this is pointing into the bearish territory and direction. This is a S&P 500, the underlying index itself, and this is looking at 11-month worth of data. So here we have, I pointed this out, this is a 92-week low, almost a 2-year low. It was an intraday low, but nevertheless, that's, it was printed. So the important thing is that we're now kind of approaching this area here from August lows, and if we do close below it, kind of like in a decisive fashion, I think we'll see this entire pattern, the depth of this pattern, duplicated on the downside. So let me quickly measure it with this tool here. This is about 11%, so if this is going to be duplicated on the downside, we're looking at about 11% further on the downside. Further down below, we see advanced, percentage of stocks above the 220-day exponential moving average, the 50-day and the 200-day exponential moving averages. This is kind of like a long-term indicator, the 200-day EMA. So we can see that it is clearly in a bearish territory. Only 26% of stocks within the S&P 500 are currently trading above their 200-day exponential moving average, which is this green line. This is very few stocks, so it's difficult for the index to move higher if very few stocks are trading above this 200-day moving average. And then last week I pointed out that on the 20-day EMA we were already getting into the overbought territory, and lo and behold we had bears take control of the action this entire week basically. Next we'll look at QQQ. Okay, this is QQQ, the PowerShares 100 Nasdaq ETF. So you can see this is a very top-heavy fund with the top 10 holdings dominating the index, over 50% of the top. Actually, this is 9 holdings because Google accounts for 7%. So 9 top stocks basically controls the entire QQQ index. But the important thing here is that we're seeing weakness in technology, and this is not a good sign for the general market. So we have, first of all, a relative weakness in technology. You can see that this is SCTR, Stock Share Technical Rank, which ranks all non-leveraged, non-adverse ETF against one another, and this is also includes bond ETF. So it is pretty much underperforming. It's right now at 38. I'm going to go back for S&P 500 ETF SPY, and the Stock Shares Technical Rank is 57. So QQQ actually is underperforming even S&P 500. Also, we have a close below September lows. This is a 98.12, and here it was 98.45. So it looks like we have an absolute weakness as well, in addition to relative weakness. Another thing here on this chart is that QQQ was one of the few funds that were still in a bullish camp if you look only simply at the 50-day moving average above the 200-day moving average. Now this is about to change, as it is pretty much imminent. This death cross or the bearish cross, 50-day moving average going below the 200-day moving average, is imminent, and is going to happen most likely Monday. So this is not a good sign for the general market when technology is underperforming, because general market consists of 20% technology stocks. So that's again, once again, not a good sign. Another thing on this chart is this advanced decline volume line actually hit a new low as well. So and this is for going back 6 months. So all of these are certainly not a good signs for QQQ. I think if we continue, if we take out this low, I'm almost certain we're going to drop to the $84 area here. Let me go to a little bit longer term chart for QQQ, and this is exponential moving averages, and the previous chart showed simple moving averages. Here the 50-day exponential moving average is already below the 200-day exponential moving average, so it's exponential moving average is slightly more sensitive. The same thing as for S&P 500, I showed how many percent in the QQQ, how many stocks within QQQ are on the trading above their 200-day exponential moving average, so above this green line. And you can see there is only 18 stocks because it's a QQQ is ETF 100. So there's only 18 stocks that are trading above the 200-day exponential moving average, and this is not enough to have a bullish uptrend. So for now, I'm treating QQQ as a bearish security, obviously, and I'm only interested in bearish setups. Next, let's briefly look at a New York Stock Exchange Composite. Okay, this is NYA, New York Stock Exchange Composite Index, a very broad index of the United States markets and probably the world as well. Because the world stocks really correlate to each other quite well. In any case, I pointed out this possible inverted cup and handle pattern a few weeks ago, We had a breakdown here in early January and then continued lower. Now, the depth of this pattern is around 10%, and we only dropped 6.2%. So for now, this inverse cup and handle pattern looks incomplete to me. And then looks like we moved back and then we continued lower. So if we, I think that this pattern needs to be completed on the downside. So it looks like we may drop another 10% from here. And this is just a rough estimate. It could be more, it could be less. But in any case, I think that we're going to be retesting January lows in the not so distant future. Here below we have new highs less new lows divided by total active symbols on the New York Stock Exchange Composite, and the bullish and bearish trigger. I use actually Arthur Hills from MasterCharts.com triggers, and they're 0.5%, 5% to go bullish, and then if once we go bearish, then also we need to go below minus 0.5%, and we're going to keep a bearish bias until we see move above plus 5%. So far we have not seen that move, and we have seen a move below negative 5% quite a few times. Again, all of the indicators are still pointing down, and as with the rest of the ETFs and the market, there are very few stocks that are trading above their 200-day exponential moving average. So in case of S&P and NYSE, there's only 19.5% of the index that are trading above the 200-day. All right, let's move on to the bonds universe. Okay, this is TLT, iShares Barclay 20 plus year Treasury Bond Fund. So a very bullish action here. We had several weeks ago, we had a breakout above these highs. We had another breakout above these highs recently, and then just this week, we had a breakout. So, it gapped up above this high from August and continued higher, and this is actually a 52-week high. So very bullish action in bonds. This is, kind of makes sense because the investors are positioning themselves away from stocks, and the logical place to rotate, of course, are bonds. TLT is among market leaders and at the very top of the market leaders too. Also, on balance volume is making higher highs and pushing higher, so I don't see any negative divergence, and this is all pointing to higher prices ahead for TLT, for bonds. Next, I'm going to show a longer term pattern for TLT, and this is a weekly chart, so each of those bars is 1 week's worth of activity. I pointed out this possible cup and handle pattern several weeks ago, and looks like we now have a breakout above the lip of this pattern this week. So it looks like we have a close above this high, above the 127.32, and also this is a 52-week high as compared to prices from here. So this was February 2015, as I just pointed out. So overall very bullish pattern. The depth of this pattern is 8.2%, but this actually could be the depth of the pattern versus this depth of the pattern, and this depth of the pattern is even higher than 8.2%. So we can see a continuation higher. And we may see a challenge to these all-time highs that were set in 2015. Again, so this is all quite bullish for bonds. So if stocks come under more selling, certainly bonds will benefit. All right, next I'm looking at XLU, Utilities SPDR. We had a breakout here together with bonds actually, so that kind of makes sense. Utilities are higher correlated to bonds than the rest of the stock funds. We had a breakout here, and this is approaching 52-week highs. They are, yeah, actually this is all-time highs, approaching all-time highs. Now, just something to keep in mind, utilities are also stocks. So in a true pandemonium, in a true sell-off or bear market, everything gets sold, and utilities will certainly also get sold. So if stocks really collapse from here, utilities will not be spared. So true safety is in cash and possibly in bonds. Um, Utilities is just an option, but you have to be very quick to exit should a true sell-off starts. So actually, next chart I'm going to show correlations of various asset classes to the S&P 500, and it will show that um, there's really not many places to hide during a true sell-off. Okay, though this is a bit of a busy chart, but just bear with me. I'll go through it pretty slow. So here, as we have four different funds graphed together in this part of the chart here. Utilities we have in orange, black is S&P 500, consumer staples XLP is in purple, and energy is in green. Okay, so you can see from here that these are all stock funds, and I purposefully picked the most uncorrelated stock funds to the S&P 500. So XLE and XLU and XLP have the least correlation to the S&P 500. If I was to pick, for example, XLF, the financials, or XLK, the technology, the correlations would be even higher. They really move in lockstep. But these three, the utilities, energy, and staples, XLP, they have a little bit of less correlation than other stock funds. But even these relatively uncorrelated assets still move pretty much in lockstep with the general market. And one thing I wanted to point out is utilities, as I just said, during a true sell-off, for example, here in 2001, utilities really got sold together with the rest of the market. And the same thing happened here, 2008, when a true sell-off started and a collapse started, utilities also got sold. So everything got sold. Here below we have correlation coefficient. This is actually a weekly chart of S&P 500 and the rest of the stock funds. Here in the lower part here we have correlation coefficients of the XLP, energy, and utilities. You can see that they spend most of their time in the pretty strongly positive territory. Pretty strongly positive correlation. Utilities, maybe they spend some time in the negative territory, but by and large, really they correlate pretty strongly. That's why I was trying to say is that, the utility stocks are still stocks, so they will get sold, together with the general market, and vice versa. When the market turns around, as utilities will also be bought together with the general market. Here is a true uncorrelated asset, and that's S&P 500 is poorly correlated with USB, which is United States bond, like a TLT. Because TLT only started around here, I used the USB as a substitute. But you can see it actually has quite a negative correlation. So most of the time, correlation is negative. So whenever S&P 500 goes up, bonds actually go down, and vice versa. If bonds go up, then S&P 500 goes down. But even these two most uncorrelated assets sometimes move together, and there are forays into positive territory. And here's a correlation of S&P 500 with gold, and it's just all over the place. Sometimes it's positive, sometimes it's negative. So I don't see a useful correlation of these two. So some people might argue with that, but for me, what the most important takeaway from this chart is you cannot hide in various sectors of the market, for example, in utilities or in consumer staples. They will eventually get sold off as well. All right, this is a US dollar index as measured against other currencies. So we had a pretty strong sell-off this week in US dollar. It actually took US dollar below the 200-day moving average, but on Friday it did rally above it again. Overall, I think US dollar is still in a bullish uptrend. Back here we had 52-week highs. We came pretty close to the 52-week highs. Challenged the 52-week highs again, but then collapsed from there. In any case, I think that the bulls are going to be stepping in now and buying this possible dip, and then most likely the prices will go up. I mean, anything is possible, of course, but I think the looking at the situation, macroeconomic situation around the world, with pretty much all of the rest of the world easing or lowering interest rates or printing money versus the dollar, it really makes sense for the dollar to be gaining in value. So next we'll look at how is this affecting commodities and gold in particular. Okay, this is gold daily spot price. Each of the bars represent 1 day's worth of activity. So I showed this pattern several weeks ago, and it looks like a cup and handle pattern to me. Now I'm not a big fan of cups and handles in a bearish security, but this is clearly playing out. So we had a breakout above the lip of the pattern here, and then a strong rally, just a continuation higher. Now, you don't have to be a genius to realize that after basically around a 10% move from the bottom here, gold is quite overbought. However, once again, the depth of this pattern is 6.2%, so from this breakout, 6.2% takes it right about to the resistance level. So it would make sense for gold bears to come in here and attempt a push lower. Now, I've read many commentators saying that this low is the ultimate low for this bear market. That remains to be proven. I don't think I don't think gold has proven that it is ended its bear market yet. And actually, next several charts, I'll show, I'll lay out my case why I don't think gold is out of the woods just yet. Okay, so this is again gold spot price on a daily chart, daily time frame. But what I did is I removed the price and I only left the 50-day and the 200-day moving averages, simple moving averages in place. And as I said before, one of the easiest ways to determine if a security is bullish or bearish is to simply look at the 50-day moving average. If it's above the 200, then the security is bullish, and vice versa. But you can see here that we had several crosses over where 50-day went below the 200-day moving average, but the bull market clearly continued. Here we had the potentially a whipsaw, but maybe this was like a very brief bear market and then a continuation higher into the bull market. Here the same vice versa, we had a bear market that started here in 2012, maybe even earlier, depending on which indicator you look, and then we had several whipsaws here. Now, last week I presented this indicator, which is in the upper part here, which is gold miners in an uptrend. This is an experimental indicator that I'm developing. It's not yet, complete yet, but I'm experimenting with it right now to see where good thresholds are, etc. It already is giving me pretty decent results because one of the reasons is I'm able to filter out many of these whipsaws. For example, all of these 3 whipsaws were filtered out by this indicator. Further below here we have gold miners bullish percent index, and this shows how many stocks within the GDX are on a point and figure buy signal. So also pretty useful indicator. We just need to, because it's a very volatile security, we need to set the bullish and bearish thresholds quite high. So here we had a bearish threshold and then a bullish threshold triggered very quickly one after another. We had continuation of a bullish bull market, and then we had a bearish trigger right there in I believe October of 2011, and ever since then we pretty much had a non-stop bear market. Now for now, if we say that the bullish trigger is around here at around 80, I have not seen a bullish trigger triggered for bullish percent index just yet. So based on this indicator, based on this moving average crossover, based on my experimental indicator, I still don't think that gold is out of the woods yet, and we need to see more participation, more upside, and more indicators turn bullish for me to go and say that, okay, we definitely have changed into a bull market. Okay, next let's look at GDX itself. Alright, this is GDX, Market Vectors Gold Miners ETF, our volatile friend. Very strong support apparently in the $13 area. I can say that this looks like a bear trap to me right now. So we had a move below the support, an all-time low, and then a quick move and a rally in the opposite direction. As a matter of fact, this closing high is at 1705, and this high is at 1689. So it actually broke above this October high, and so this is very good action if you're especially if you're able to buy right here at the bottom. Also here you can see there's a big gap here. So gap above the 200-day moving average is also a positive sign. But this gap will eventually need to be closed. We don't know when. This could be, if this is the beginning of a new bull market, we could see a continuation higher and a breakout, and maybe a 50-day moving average moving above the 200-day moving average, etc. For now, once again, I have not seen that. Further below, we have some good news for the gold bulls. Looks like we have a pretty broad participation, at least as measured by the bullish percent, by the advanced decline line, advanced decline volume lines, and on balance volume indicators. So that's all positive news for the gold bulls. Now here below, once again, I'm showing the bullish percent index. It's currently at 31%, and as I showed in the previous chart, I think we need to get somewhere around 80 before I'm going to say that we are now in a new bull market. I could be wrong, of course, and maybe a bull market will start without the bullish percent index changing and rallying from here. And then finally, I want to show a bit of a longer term picture for GDX. So here we have somewhere here in 2011, 2012, looks like we have a support break from these lows, and then many of the indicators changed, and then we have a beginning of a bear market. We have 1, 2, 3, 4. This is the fifth breakout above prior highs that I could see on this chart. Maybe there are more, maybe I missed some, but there were at least 4 previous breakouts or purported breakouts above the previous patterns that ultimately resulted in a sell-offs and new 52-week lows. So a breakout, a sell-off, and a new 52-week close, etc. So maybe this is the one. And by the way, this is a weekly chart. So maybe this breakout is indeed the one. I mean, this looks like a very nice looking bullish candlestick. So it's possible. But we don't know. Maybe we're going to turn around and again make a new 52-week low. So again, I need to see more evidence of gold turning bullish by seeing more indicators and more participation within the index itself. Okay, let's briefly look at oil, West Texas Intermediate daily spot price chart. Um, Not really much going on here. I thought this was a bullish engulfing here on, let me see, this is Friday, Thursday, Wednesday. So this is a Tuesday, Wednesday action. Looks like we had a drop down, and then this is could be like a bullish engulfing pattern. But so far it has not been confirmed. Like there was not enough upside, but upside action. In any case, this is a bearish security, so I'm only interested in bearish setups, so I'm not even looking to pick bottoms or anything of that matter. But I really don't have any positions right now. I'm looking for a substantial rebound to even contemplate any kind of short setups. Yeah, on balance, volume is confirming lower lows here as well. All right, let's next look at natural gas. Okay, natural gas spot price daily chart. Also, bearish security, no ifs, ands, or buts about it. This is multi-year low. Uh, 50 days below 200-day moving average, etc. So only looking for bearish setups. Looks like this is a possible rise in wedge and a possible rise in wedge break and a continuation lower. But this Friday action, maybe this is kind of like almost like a bullish engulfing of some sort. Plus, there is this bullish divergence. We can see that on balance volume is actually pushing higher, while the index itself, or the natural gas price itself, has pushed lower. So maybe I should trust the volume and see if smart money is accumulating here. Difficult to say. In any case, I'm not looking to go long, only looking for bearish setups. Um, that's it for this week's recap. Please stay tuned to how to find us on the internet. My subscribers are getting really good results, and please stay tuned how to find us on the internet. Thanks for watching, and have another great trading week. Bye-bye. So I wanted to show you how to find us on the internet. Please go to MasterChartsTrading.com. We do have a trade alert services that are now active. Please consider subscribing. You get 3 weeks free trial, and it's only $24.95 per month thereafter. You get access to my charts, exactly what I'm buying, exactly what I'm selling. I have an internal blog. Also, I have several videos that have to do with trading and various aspects of um, risk control, as well as just a psychology of trading. So please do consider signing up. The subscribers are getting really good results, I think, and I'm getting some very good feedback. I have a performance section here where I post the actual portfolio percentage change. The inception date was in 2015 October, so it's not a lot of history yet. And there's some backtesting results that I feature here as well. The blog, of course, is where you'll get this information, and there's a video section where I separate them out for easier access. Click on the social page, and here we have a link to public charts page where most of the charts that you're seeing in this video are going to appear. You have Twitter, Facebook, YouTube, StockTwits accounts. You can find us there as well. If you subscribe to our mailing list, you'll get a special price for our trade alert services. That's it for watching. Thanks for watching, and have another great trading week. Bye bye.